All right. Well, good morning to everyone that's on this morning, and just want to welcome you. We're glad you're here with us on this beautiful fall day, and it's been a little while since we've had one of these meetings. So Brent and I thought it was time to get together with you again and go over where we are as we're getting a lot of questions regarding the PPP forgiveness application. And as the meeting is titled today, your PPP covered period is about to end, and so now what? So again, I'm Steve Moyer, and Brent will be speaking today. He's done a lot of work in putting these slides together for us. And so previously in earlier meetings, we talked about how we're building a bridge. And bridges have a lot of, I'm certainly no engineer, but I know there's a lot of work that goes into building a bridge. And the bridge is currently being built, and we're trying to get our businesses to the other side. So I just want to take a few minutes to reflect on where we've come from. It's been about 7 months or so since the CARES Act was passed. And a huge component of the CARES Act is the PPP loans. So just reflecting on the complexity of all that's gone into this, the CARES Act is 880-page bill, and it came into being rather quickly, over a period of a couple weeks. Bills usually don't get passed and signed by the president in that rapid rate, but we had both sides of the aisle coming together and creating this bipartisan bill, which was a $2 trillion bill. So just like bridges have different components as they're being built, the rebar, the concrete, the footers, the PPP loan also has different components. Came out with who was eligible for it, the loan amount, how that was calculated, the application and filing for the loan, what the funds were, you were able to use those for, the forgiveness piece that we hope most everybody will be able to get forgiveness on this loan, as that's what the big bonus of this is that it's really not a loan, but it was money used to be spent to keep businesses alive and employees employed and being able to get paid during this difficult time. The bill was signed into law back on March 27th, and then within a week after the bill was signed, both the Treasury and the SBA worked together to get the rules out. It was chaotic at times, and I just remember many days where we were like going back and forth reading what was being put out there by them, and saying that's not what the law really says. So over the course of time, they've issued 24 IFRs, which are Interim Final Rules. So that's some of where we get our answers from. And then they also published 77 FAQs. So the interim final rules were about over 100 pages, and the FAQs take up about 25 pages. Also, during this last couple of periods, last couple of months, there was some additional things that were published, some executive orders. There's a Families First Act. And then moving forward, we're hoping that we get some new legislation that we know is needed out there for businesses and individuals. And so there's the potential of PPP2, although that seems to have come to a stop this week. Negotiations seem to have come to a stop, and there's a possibility that we might get some pieces from that that the government finds to be important at this time. So hopefully something will get done. All right.
So Steve, just a couple of housekeeping items real quick before I go over this slide is, again, this is a Zoom meeting, so you should be muted upon entry, and we'd appreciate it if you would stay muted. Video, we don't care, but again, it is a Zoom meeting, so if you don't want everybody to see, you can turn your video off. If you do have questions, please feel free to send them in to either Steve or myself through the chat function, and that's how we'll handle it as we have in the past. So appreciate having everybody back. This is our 4th installment, and I see that a lot of you have been here through all 4, and we appreciate that. As Steve said, we want to do these when they make sense and you get value out of it. So there are a couple that are joining us for the first time here, and we're sure that this is gonna be worth your time. So we last met, as Steve said, it's been a while, on June 11th, and this is kind of what has happened in the meantime chronologically. Not gonna spend a lot of time on this slide because we're gonna go through all these things, not in any great fine detail, but just bring out the points and things that you need to be aware of that has happened over the summer. We have communicated these things via email over the summer, so hopefully this is a little bit of a recap, but again, we'll walk through, not in great detail, but not just brushing them over either. So this is kind of our agenda for the day. So before we get into that, there are a few odds and ends, and I'll turn it back over to Steve to go over a few of these before we start.
Okay, thanks, Brent. Yeah, so the state of the IRS, mail and responsiveness. I'm just gonna take a little bit of time here because some of you may have received notices from the IRS saying that your payment hasn't been received for your 2019 tax return, and you may have mailed it in back in April, or the new updated due date of July 15th. It was mailed in, and a couple weeks later you got a notice from the IRS saying they never received your check. Well, part of the problem is when pandemic hit back in March, the IRS extremely limited its workers coming in to the office, live service, telephone assistance, and correspondence, responding to correspondence was extremely limited. At one point, the IRS had a backlog of more than 11 million pieces of unopened mail. And as of October the 2nd, still 5 million pieces of unopened mail, about half of which are tax returns, remain unopened and are stored at various IRS processing centers. So don't be surprised if you receive a notice from them saying they haven't received your check, they haven't received your tax return. The important thing to keep in mind is that you want to, even though you sent it in, even you might have sent it in certified return receipt and you still got a notice, make sure you respond to that notice. Don't throw it in the trash. It's important that you follow up with it. If you can get through, or you have your tax preparer, CPA, get through on the phone and let them know, that's the best option, and then follow it up by mail. But you know, if you send in another piece of mail, it might continue to sit in that pile. The next item on the list there is COVID-19 relief guidance. We just passed a due date back in September 15th for business returns. If you know there was a problem getting your business return filed, or now we're coming up on our extension due date of October 15th. So keep this in mind. If there's any problems in getting your return filed, the AICPA has been in correspondence with the IRS, and they are suggesting that you write COVID-19 or get it printed on top of your return so that they know that there's an issue with filing your return, and that should help eliminate any penalties for late filing. If not, there's also the IRS has a reasonable cause standard for late filing, and you can always use that. You can contact your tax preparer if you get any notices on this, but just keep those things in mind. It's important that, you know, especially at this time, you know, that we can probably get around some penalties for late filing based on the situation. You just have to, you know, state as to why you couldn't get your return filed. Taxability of forgiveness. As you remember, the PPP loans came out, and they are supposed to be tax-free when they are forgiven. The IRS just announced also that there will be no 1099-C forms issued by lenders. A 1099-C is for forgiveness of debt. But back to the expense side, the IRS came out and said that the expenses would not be deductible based on one of their revenue rulings. And this was not what the lawmakers had intended. There is, you know, some bills, you know, somewhere in the Congress trying to get that through to confirm that that was not the intent. At this point, though, we have no thing to stand on as far as the expenses. So we're just kind of waiting to see what happens with that. And we'll discuss this a little bit further as we get down the road here. Pending legislation, as I mentioned, we're hoping for some PPP2 possibilities. There was about 150 billion left unused from PPP1. So there's been talk this week that some of that money might be able to be used for the next round, or some other stimulus, such as checks going out to taxpayers, unemployment increases, and so on. Automatic forgiveness is another item that we're waiting to hear. There's proposed legislation that would allow for loans under a certain amount to be automatically forgiven, and what we've been hearing was a $150,000 limit. And as a matter of fact, most loans that were issued are under that $150,000 amount. So many of the loans out there may not even have to go through the forgiveness application if this goes through. There are certain banks that are currently out there that are not even accepting applications at this point for those loans under 150,000 in anticipation of some bill getting passed that those will not have to file the application for forgiveness.
Yeah, Steve, and in terms of the local banks, I know for a fact Quakertown has a few applications in with the SBA. I believe Univest is not accepting applications yet. Santander, not a local bank in mind per se, but they're not accepting applications yet. And Harleysville, I'm not quite sure. If anybody's aware, if you guys could just chat in, I'd be happy to share the information with you as the slides go here. So.
Okay, this is certainly, so accounting for PPP loans. We'll just go over this real quick, but Brent and I, many weeks over the summer, have been on weekly calls with the AICPA, and one of the questions that always comes up is, how do you account for PPP loans? So just to make you aware that there's the AICPA has issued 4 possibilities for accounting for the PPP loans and the forgiveness piece of it. So the first one is fairly straightforward. You account for it as a loan. You have it on your books until you receive the forgiveness amount, or until it's paid off, including any accrued interest. The other possibility is to record it as a grant and record deferred income as a liability, reduce with offset through earnings as expenses related to the loan are recognized. Another one is and that was for the International Financial Standards Board. The FASB has also given a grant possibility. And then there's a gain contingency. The point with all of this, the accounting for it, is typically you'll discuss these with your accountant and how you want to handle that for your company or your organization. But you also want to make sure you get your banker involved in this, in some of the discussions, because you may have a financial statement that's prepared for you, and you may have a loan covenant. So with the recording of the loan, of this PPP loan, that may throw your debt covenants off. So the banker may not be happy about that, but I think if you you know, just make sure you keep the communications open and, you know, have those discussion with your bankers.
Yeah, and I think the point on this slide too, Steve, is I think the for-profit world would be the loan under number 1. It's a loan on the books until it's forgiven or paid. The second's international, which I'm not sure would affect many, if anybody, on here. And the third and fourth are nonprofit, which is a little bit outside my world. But I know we have some people on the call here. So, so getting the bank involved or communicating with the bank or seeing what they say is really, really important. You want to keep in mind through this process that they're on your side. They want this loan off your books as well, because it's out there at, you know, whatever, 1% or whatever. They can do a lot more with that money if they get it back. And, you know, the way it was explained to me, it is their money until the application is processed by the SBA and actually forgiven, and then the SBA would send the bank a check at that point. So the bank wants to get this off of your books just as much as you want to get it off your books. And to go back, I forgot to make the point earlier in that the SBA, to my knowledge, Steve, as of last Thursday, has not approved any loans or denied any loans yet. They just haven't ruled yet on any that have been submitted. There's 5 million of these loans out there, and I think under 50,000, right, Steve, were applied for forgiveness so far. It's a very small percentage.
I know the percentage was about 2%, so I'm not sure on the number of loans, but I know it's really small at this point.
Okay. Yeah, and we'll talk about the timing and logistics a little bit coming up. But, you know, again, probably the last things to keep in mind before we go into that agenda, if you will. So you had to certify with the initial application that, quote unquote, current economic uncertainty made the loan necessary. Now, you initialed that and certified it on the application, but obviously there was a lot of questions to that. What did that mean? And they came out with a safe harbor. We went through this in one of our previous presentations. You know, it says any loan that was under 2 million, that certification was done in good faith. So they're going to assume that you had economic uncertainty. But they also said any loans over 2 million will be subject to extra review by the SBA. So if you're sitting with a loan that is over 2 million, you really probably will have to submit documentation as to why economic uncertainty made the loan necessary. Now, it doesn't mean that if your loan's under 2 million, you don't have to document this, because the SBA retains the right to review any of these loans for 6 years. So you don't have to include it with the application for forgiveness, but it may be a good idea just to write down a couple paragraphs of how or what you were feeling at the time that made you uncertain. And that shouldn't be a difficult exercise for small business. If, again, your loan is over 2 million, I would have very, very good resources. I'd encourage you to maybe reach out offline here, and I can get you probably some good resources in terms of food for thought and documentation. So, lastly, again, with the bank, not all the original loan agreements are the same because this was done in such haste. All the loan agreements, and there was subsequent laws passed after the first wave of loans went out. So all the loan agreements prior to June 5th are absolutely wrong and have incorrect wording in terms of covered period, payment due dates, the 75-25 ratio for payroll, which went to 60-40. Again, the loan documents are wrong. So if the bank used their own agreements, there may be stuff in there in terms of distributions, forbidding distribution, ownership changes, things like that. So keep in mind that you really can't certify with the forgiveness application that you complied with the loan terms, because the loan terms you signed off on are not the loan terms any longer. I don't know how the banks are handling this. I asked a few of them to come on today for 5 or 10 minutes, and unfortunately they all gave me a pass because they're not getting guidance from the SBA and stuff yet. So they're in an uncomfortable position. So I did see emails. Honest, I forget what bank it was specifically, but they just put an email out and said, your loan documents say this, just disregard it and move on. I'm not sure if that was their whole game plan, but again, you're going to have to weigh risk here in terms of if you have a $20,000 loan that's going to be automatically forgiven potentially, or forgiven because you spent money or whatever. The risk isn't as large as, again, an over $2 million loan. You may want to address some of these things, prior to certifying that you complied with the loan terms. So again, just something to keep in mind, as you go. So we're going to jump actually into what the new laws and interpretations and stuff that came out over the summer. So I'll toss it back to you, Steve, and I'll check on a couple questions, but maybe after this slide. I think I have one or two. So.
All right. So yeah. So on this summer, there was about 5 IFRs issued and released between June 12th and June the 25th. This one specifically that we're discussing has to do with the timeline of the applications and the lender and the SBA's responsibility in responding to those applications. So each business has 10 months after the last day of their covered period to apply for forgiveness with the lender. Once the application is submitted with the lender then has 60 days to determine, based on the information that's submitted, all your documentation, your hours, your reports, your payroll reports, FTE reductions, all that. They have 60 days to determine if all of it's going to be forgiven or a portion or none of it. And again, just to highlight, the lender isn't responsibility to determine if the business was eligible. That's the business's job to certify that they were. And then once the lender makes a determination, they forward it on to the SBA, which the SBA then has 90 days to review and agree or disagree with the lender's determination on forgiveness. So that's the timeline there. There's another FAQ that we're going to look at in a little bit. That's very similar, but it's more has to do with the business and their responsibility during that period of time. So, all right. So here's, we've been getting the questions a lot. Should I apply for forgiveness now, or should I wait? When do I need to apply? So here are some questions to consider when in determining when to apply, if you should do it now or do it later. Have you spent all the money that was allotted to you at this point? Remember, we have the 8-week or the 24-week covered period. So you can, you know, extend that period to the 24 weeks, which I know a lot of, once that option was added, a lot of people are going with the 24-week period. Is the lender accepting applications? We discussed that previously. A lot of them at this point aren't accepting certain dollar amounts and so on. Does the borrower need to make business operating decisions that may include reducing your FTEs? In other words, you know, do you need to, you know, lay off people? Do you need to reduce your workforce to keep your business going? And hopefully you're, you know, making that decision in conjunction with your advisors. But the point here is once you send in your application for forgiveness, you have no more responsibility for those FTEs, meaning once that application is submitted, you are then free to reduce if need be. What tax planning can be done around the deductibility of the expenses paid? You know, as we mentioned, we don't know. At this point, the IRS is saying the expenses that are paid with PPP funds are not deductible. Congress doesn't agree. That wasn't the intent of that. So are they going to come out and override this with some new legislation? We don't know at this point, but what do you do when you're, you know, you may have a business and you may have a fiscal year. Your fiscal year may have ended and you paid expenses with, you know, the PPP funds. Can you claim those when you file your tax return? At this point, the rules that are in place say you can't claim those expenses. So probably what you want to do is file an extension, you know, until we know the answer to that question. So we anticipate there might be a lot of extensions filed this year if we don't have answers to this question. Is the loan over or under the dollar amount of potential threshold for simplified forgiveness? So again, the number that was being talked about was 150,000, but it may end up being a lower amount, but we don't have an answer for that. So if your loan is under that dollar amount, you might want to wait, and because you might be doing work that you don't need to do down the road. Is your banking, your debt covenants, are they out of compliance? Do you need to get those taken care of and reduced before you get your financial statement prepared to give to the bank? So that may be a reason that you want to file sooner rather than later. Is the borrower trying to sell the business? And we just had guidance issued from the Treasury this week on change of ownership. So they put out some guidance regarding people who might be selling a business, also for the buyers of the business, what's their responsibility? So these are some things to consider. And we'll keep moving on.
Steve, just to add 2 quick points is before we said you can apply to the bank and the SBA, there are appeal rights. We're not going to go into them with this presentation, but if the SBA comes back and denies all or portion there are appeal rights, but obviously you don't want to go through that. So you want to do the best job you can with the application the first time, which again leads to more waiting than immediate. So I would throw that in here as well. And the tax planning point, with the timeline we just laid out, excuse me, if the SBA has 90 days, even if you got it in this week and you know, the bank threw it at the SBA at, you know, the end of next week or whatever, the SBA still may not make a decision until 2021. So getting this done in 2020 is, you know, I don't know. The SBA may, again, they have very few applications. So is it going to go through sooner? Or are they going to take their full 90 days for whatever reason? You know, so I have to imagine they've had an extremely busy spring and summer trying to get all this in line. I'm not so sure how quickly the application forgiveness is really going to get ramped up per se. So just wanted to add those few things.
Yeah, just to that point on the SBA, the 90 days, at this point, I think they still have, you know, just as we have certain questions, I think they don't, all the people that are responsible in the SBA still have questions also. So that might postpone, you know, prolong their time period.
Yeah, and there is really, really strong, I don't want to overemphasize, but there is really strong bipartisan support to get rid of the loans that are under 150 and make the expenses deductible. So I believe more probable than not that those things will come through. So if you would file your application now, get it forgiven, and you file your tax return in February or March, you're going to have to pay tax on that potentially. Then you got to file an amended return if a new law is passed and stuff. So again, that would lead towards leaning to wait at least until January or February at minimum, so you know you're not going to have a 2020 issue. So Steve, I don't have any questions. I don't think that we really addressed. So unless you have any, then just keep chugging.
Right. I don't have any questions at this point.
Okay.
Yeah, feel free to ask any questions as they come up. So another IFR that was issued in the month of June. Previously, for those of you that were on earlier calls, we had questions that continually came up on year-end retirement contributions that would have been paid during the covered period. We took the position that we thought that they would certainly be includable in that period as an expense for forgiveness, and this IFR did in fact confirm that any 2019 year-end retirement contributions that were paid during the covered period would be able to be used for forgiveness. It also included further guidance on owner compensation limits, but at that time they did not really define who was an owner. What if you owned a small percentage of an S corp? What percentage made you be considered as an owner? So at that point, there was not the definition of an owner. That has subsequently came out, and we'll discuss that later on.
So then over the summer, the applications came out and they went through a revision. At this point, there are 2 applications. The latest version was the June revision. So at the, I believe the bottom left of the form, it would say 6/20. There is the form itself is 3508 for the application for forgiveness. You can get it from the Treasury or probably even the IRS site. And there's a EZ form, which is a scaled down version. And we're not going to go through the applications line by line. We're going to go over a few things. Before I forget, the slides that went out, this phrase in red here, in reviewing for today, this phrase in red, I noticed I did not include in that slide. So if you're taking notes, just make sure that that gets inserted there. So the EZ form you can use if one of the 3 situations are applicable. And the first one's pretty easy, self-explanatory, and that is if you're a self-employed person, Schedule C, single member LLC, and you don't have any employees. All right. The second scenario that you could use the EZ application is you didn't reduce the annual salary or hourly wage of any employee by more than 25% during your covered period from comparing it with January through March. And the borrower did not reduce the number of employees or the average paid hours between January 1st and the end of the covered period. Now, let's unpack that a little bit. You get to ignore, if you do have reductions, but you get to ignore reductions for the inability to rehire employees. So if you let them off and then got your PPP money, went to bring them back and they refused to come back, that doesn't count. And you couldn't find a similar employee, you tried but could not, that is not held against you. And when we're talking about employees, we're only talking about those that paid $100,000 or less during any single pay period, an annualized value of $100,000 or less during a single pay period in 19. If you have an employee earning over $100,000, you can reduce them as much as you'd like. Now, again, a little bit confusing, you know, didn't reduce from January to March compared to number 2, if you just put it in English, you didn't reduce anybody by more than 25% from January 1st to the end of your covered period, whatever that is. And again, just knowing the definition of an employee is under 100,000 for this purpose. And you're not going to be penalized for an inability to rehire employees. Okay, so that's number 2, hopefully a little bit more in English for you. The third situation is very similar. So note that there's no dollar amount on any of these situations. So if you have a $5 million loan, you can still use the EZ form. And it's just a certification on the application, if you will, that you have to sign and initial. So the third scenario, which you could use the simplified form, is again, you didn't, same thing, reduce anybody by more than 25% from January through March, and you, the borrower, were unable to operate during the covered period at the same level of business activity as before February 15th due to compliance with requirements established or issued between March and December. Again, same caveat that the employees are only under 100,000. You can't reduce by more than 25%. All right, but this operating at the same business activity level is basically saying that there were guidance issued by certain authorities that you were physically unable to operate your business. All right, and that's what this number 3 basically says in English. And Steve's going to walk us through the guidance and take us through a really simplified example, if you will. So Steve, I'll turn it back to you.
Yeah, so this is another one of the FTE, full-time equivalent, reduction in safe harbor exemptions, which exempts any loan forgiveness reduction based on, a reduction in full-time employee levels. So the operating restrictions is when a borrower is unable to operate between the February 15th date and the end of the covered period at the same level of business activity as before February 15th due to compliance with regulations established or guidance issued March 1st through December 31st by either the HHS Secretary, CDC Director, OSHA, or related to the maintenance of standards for sanitization, social distancing, or any other worker or customer safety requirement related to COVID-19. And this has a December 31st restore date. So you can restore up until December 31st and on December 31st to the same level that you were prior to February 15th. All right. So just a quick example. And this was from one of our weekly meetings with the AICPA. They put out this example. The borrower has online sales in a physical store. During the period, the local government ordered all non-essential businesses, including the borrowers, to shut down based in part on guidance issued by CDC in March. Borrower's business activity during the period was reduced compared to the activity before February 15th. So the borrower would then satisfy the safe harbor for this. Their forgiveness amount is not reduced because of a reduction in FTEs, and it requires a good faith to maintain records. Records, and I'm going to just emphasize this. I'll emphasize it now, and it was one of the points I was going to bring up later, but maintaining good records are so important for this. Keeping those records as you go, reasons why you had to reduce your activity. Make sure you document all this as you go. It's really going to be important in filing the applications for forgiveness. And
yeah, so just to be, I guess, a little bit clear too, Steve. So all the things that were mentioned here were federal. Go back for a second. So all the Secretary of Health and OSHA and stuff, it doesn't expressly say, but they have interpreted that, so say Governor of Pennsylvania here that we're familiar with, Governor Wolf, shut down all the non-essential businesses. That, if you actually look at that order, he would say he's doing that based on guidance from CDC.
that's correct.
Yeah, so if you're what was termed or deemed as a non-essential business and were shut down for any point in time, you would meet that safe harbor based on Pennsylvania or localities doing it, because they're going to base their orders, lack of a better term, on guidance from those issues. So, you know, again, a lot of these things, and I'll say it now before I forget, the applications, and I'll point this out on my slides here, you know, the applications were drawn up in a hurry like everything else, and a lot of them are missing points or not consistently worded between each other. So if you have local guidance, I say all this to say, if you have local guidance or rules and regulations that affected you, even though it's local, you should meet that safe harbor requirement to not be able to operate. So in the applications, both of the applications, again, the easy, you just kind of have to initial that this is the case. The longer form, you would have to report with FTE calculations. But in either case, there's some exceptions and then there's safe harbors. And again, just to recap, the exceptions, you're not going to be penalized for an FTE reduction for any position in which you made a good faith written offer. This is key, written offer to rehire or restore in full an individual who was employed but you had left off before you got your PPP money, and the employee rejected that offer and you were unable to hire a similarly qualified employee. So again, you can document that you're not going to be responsible for that. And I have a couple questions, this bullet point, but again, this bullet point is going to answer those questions. Any employee who during the covered period was fired for cause, voluntarily resigned or retired, or voluntarily requested a reduction in hours, you will not be penalized for that. Now, what's interesting is, again, this carries through for both applications, but this second bullet point is not expressly stated on either application at this point. So you're not going to see that on the applications. And again, I suspect that there's going to be some drafts coming that the SBA went through and drafted all that stuff, and then they changed the law. So I don't know that the SBA is in a hurry to draft the applications and have the law change again for the under 150,000 loans and stuff. So we'll see. But again, I'm telling you with full certainty the second bullet point is valid. It's just not expressly stated on the applications. There is 2 safe harbors, though again, the verbiage between the application is inconsistent. We talked about the operating restrictions. We just got done talking about. On the EZ, it's listed as an exemption. On the long form, it's a safe harbor. You know, what's in a name, I don't know in this case, but again, it's just not consistent. And Steve talked about the December 31st restore date. All right. You have some comparisons you have to do. Excuse me. If your FTE level did reduce, you can restore it by no later than December 31st. And if you do that, again, you can certify that, and you know, you would not be penalized for an FTE reduction. All right. 2 points here, well, 3, if I can remember. Again, you're free to manage, so this is a restore no later than December 31st. You're free to manage your business on January 1st, okay? So if you restore by, I wouldn't do this, but if you can restore by December 31st, you're free to do what you want on January 1st, as soon as that application is out, if you will. The second is, it's unclear how this application can be made prior to December 31st. You can only, you can apply for forgiveness early. So if you're in your covered period, you've used all your funds, you can apply before the end of your covered period. You have to do some allocations and stuff. It's a little bit more work. But again, if you apply before December 31st, I don't know that we have any guidance out here that says how this restore date certification would work. So just keep that in mind.
Brent, I have a question here before we go on out of the FTEs.
Okay.
So the question is, my understanding was also that you can compare the covered period number of FTE and salaries versus the last year's same period. This is no longer the case question. It will always be compared to January to March 2020.
I don't know the rules for seasonal business off the top of my head, but that would be the only place I think that you could potentially compare to the same period in the prior year. Again, I don't know those seasonal rules off the top of my head, but what we are telling you here is consistent with the applications and the guidance. Excuse me.
So that is, other than the seasonal employee scenario, that is correct, that it would be the January, March 2020 would be what you're looking at for the FTEs.
Yeah, and I'm good on questions, Steve, so you can go ahead with this slide.
Okay, this slide is, again, I mentioned it earlier when we were looking at the IFR, but this is a FAQ that was issued by the SBA, and it was FAQ number 3 under general loan forgiveness. And it's, again, speaking to the due dates and the timing. So here, what we want to point out is there are no, so you have 10 months as a business to, after your covered period, to get your application filed. The bank then has 60 days to review and submit to SBA, and then the SBA has 90 days to make their decision. And as Brent previously noted, there are appeal rights if you don't agree with their decision. But the thing that I wanted to point out here is that, if you do the math, 10 plus 60 plus 90, that's a 15-month period of time that you will potentially be, waiting for a decision and not have to make any payments on that loan. So there's no payments due until you get the information back from the SBA and that this determination of how much is going to be forgiven, whether it's the full amount or if only partial. But if it is only partial, then you will have to, make payments on that, along with any accrued interest on that portion of the loan that is not forgiven. If it is 100% forgiven, there's no payments due at all. All right, so here we're going to talk about some other FAQs that were issued in August. Some of these you might remember that we talked about questions that we needed answers to, and we did get some answers for these questions. So the first one, it was just reinforced previous determination that bills and expenses incurred during the covered period. So in your 8 or 24 week period, they were incurred but not paid until the next billing cycle, they are eligible to be included in that expense for your covered period. Payroll costs, this was again, we went back and forth on this, but payroll costs incurred before your covered period, but paid during the covered period are eligible costs. This one, I think we knew this all along, but you are to use your gross wages and not anything other than that as far as your wage expense. The next one, we previously mentioned about the possibility of hazard pay and bonuses and lost tips for certain employees. They can be included as additional pay over top of pay that you would have normally paid the employee before. That was clarified. Only the employer share of health insurance is eligible, not the employee's portion that they pay. Again, I think it's something that we knew, but they just needed to clarify. Interest, if you remember, interest on a mortgage that is secured is deductible. Interest on any non-secured credit is not eligible. And this was one, the last one is one that we went around and around. What were they trying to say by transportation costs? They clarified this, and it's not gas for company vehicles. It is transportation costs to for utilities to get the utility to where it, or whether it's gas or whatever, to transport that gas to the destination. That's what they mean by transportation costs. So that was clarified.
All right, so at the end of August, they came out with another interim final rule here. And this is the one where they did clarify the definition of an owner. I think Steve had talked about this back in quote unquote June, on the June slide, if you will, but it took till the end of August, and they were already accepting applications at this point, Steve, weren't they? It was like August 10th or 20th or something, potentially, that they would accept.
Yeah, I'll have to, I don't remember exactly the date when they started accepting, but it was
before the 24th.
They stopped accepting applications for new loans on August the 8th. So
yeah, I meant the forgiveness portal was open even. So regardless, it was before the 24th. So even after they had the forgiveness portal, quote unquote, opened, they still didn't clarify the definition of an owner until afterwards. And it came out as 5% and over. So anybody that is a 5% and over shareholder or partner in a partnership, you're considered a owner employee, and you'll be subject to limits that we'll talk about real quickly shortly. These other points were I talked about the anti-abuse way back in the beginning, that all this stuff would have to come out later. These are really centered around my term in terms of self-enrichment. And if you think of it in terms of self-enrichment, they kind of make sense. So if you have a space that you lease, but you sublet it out not all of your lease expense it can be used for forgiveness. You can only use the net. So they're not going to let you take the PPP money and collect from your sublessor as well. So only the net. So you're paying 10, collecting 25, only 75% would be, or 7,500 would be eligible for forgiveness. If you're in a situation where you prorate the rent and utilities, you have to do that the same as your 2019 filing. And this is most common in home-based businesses. So you're not allowed to throw your full utility bill on there now or change your allocation. This one is going to be fairly common, but rent to a related party is eligible for forgiveness, but only up to the mortgage interest incurred by the related party. So a lot of you have your business location that you operate, let's say out of an S Corp in the most common scenario. You pay rent to a related entity that is a partnership that holds the real estate, and that partnership holds a mortgage potentially. The rent that the S Corp pays to the partnership, you can only take the portion that is equal to the mortgage interest incurred by that partnership. And again, this had to exist prior to February 15th. You can't go out and get a new mortgage and start this up. Leases had to be in place as of February 15th as well. But again, if you think about this in terms of self-enrichment, it makes sense. Mortgage interest is the only thing that you, the owner of both entities, are really out of pocket. All right. So mortgage interest, but kind of a sub-bullet point to that, mortgage interest paid to a related party is not eligible for forgiveness. So again, if you're paying mortgage interest to yourself, that's not going to be eligible for forgiveness. So there's a lot of rules and stuff that have been coming out, if you will, or they talk to. It's all kind of around self-enrichment so far, if you think of it. So, excuse me. So, borrowed a couple slides here from the AICPA town halls that we've been attending most weeks. I'm not going to go over this in any, again, great detail. The important part is at the bottom left. Here are your owner compensation limits for your 8 weeks and your 24 weeks. And you'll see there that a non-owner employee, their compensation limit for an 8-week covered period is $15,385, and on the 24 weeks is $46,154. And that's just, those numbers are 100,000 divided by 52 weeks times 8 weeks times 24 weeks. It's a straight formula. If you look at the owner employee, again, over 5% shareholder or partner, it's the same 8-week period because that's what you could borrow off of, if you will. The 24 weeks, they only bump you up to $20,800. And again, this is the idea of around self-enrichment. And if you remember way back to our first presentation, I said inherently the way that they were doing the math, there was going to be a proportion that was not going to be forgiven for sole proprietorships and such. So again, this is two things. This again is the 100,000 divided by 52 times 8. The 24 weeks is 100,000 divided by 12 months times 2.5. That 20,000 is the most, the cap that you were able to borrow against. So they're not giving owner employees any more credit than what they were able to borrow against. The non-owner employees they are, but the owner, they are not. Now, why is this? Very simply, let's take again, the idea of self-enrichment. If you had 2 employees, right, and you borrowed against payroll for 2 employees, but then you let your other employee go and you just decided to pay yourself both salaries. All right, that wasn't the purpose of the program, to enrich you, the owner, with both salaries. So again, it's the idea of self-enrichment. I don't know that we have to get into this. I kind of disagree with some of this S Corp stuff as the owner's health insurance not being included, because they're saying it would be included with the W-2. Well, that's on the federal wage box of the W-2. It's not gross wage. So I think we have to, there's still some things out there that have to be cleaned up yet. But again, I've told a lot of you this, in that you were able to borrow for 2.5 months, but now you have, you know, a 24-week, you know, 6-month covered period. So, you know, hopefully with a very, very large portion of everybody here, you know, payroll is going to be your only thing that you have to report. If not, then rent, you know, hopefully would take the rest. And you don't have to get into electric bills and interest and allocating all kinds of stuff. So, excuse me, we'll see. So on this slide, I just want to, you know, it probably for your reference for reading later. Again, I don't want to dive too deep into the weeds and lose everybody here. I want to be conscious of time as well. But you can see, again, and maybe Steve, this is where the question for the 2019 compensation came in that you're only allowed as an owner employee as well to use your 2019 compensation prorated. You can't give yourself a raise. And again, if you were making under 100,000 as an owner and paying yourself 50, you can't give yourself a raise to 75,000 and now, you know, include all that. So you can see in the column that's eligible for forgiveness, the AICPA used the Brady Bunch here. So Marcia is at 15%, so she's over 5%. She is an owner. Her compensation for 19 was 45,000. Prorated, that would be 9,300. Here's her 24 weeks, but again, she has the max as an owner of either her 19 wages or from the previous slide, the $20,000 number. The lesser of the two is 9,300. And you can kind of go through here and see, you know, Greg is 3, so he's not an owner. So he gets the non-owner employee max rate here. So again, I think if you use this slide in conjunction with the previous slide, you know, to kind of look over and familiarize yourself with, you should be able to do it here.
Yeah, I think, Brent, I think the other point on this slide is that, and you mentioned it earlier, that if you're an owner, you can't give yourself a raise, but Bobby, who's a 4% owner, he was eligible for the raise from 45 to 85,000 for the year. So his compensation was allowed to be increased for this example.
Yeah, exactly. So he got his compensation here in 24 weeks was almost all of his compensation in 19.
Right.
So, you know, again, so you can kind of look this over and see. I think if you can read this, and hopefully it'd be fairly self-explanatory. I will say here, this is probably a good point, is a lot of payroll vendors, if you outsource payroll, including ours, I think they all have at this point reports ready to go that revolve around the PPP and applications and specific tables and stuff like that. So the payroll software, I think, has come along and it's kind of ready to go. It's just, again, everybody's hesitating to pull the trigger to apply for forgiveness, you know, waiting on pending legislation, pushing off the potential tax issues to 2021 and such. So, and again, the timeline, as Steve said, you know, we can play that out to 15 months if we so desire. So I'm not quite sure. There are certain circumstances that we would do it now, potentially if you're trying to sell your business. I think at the end, if we have some time, Steve, we could maybe touch on that real quick. It's probably not too common. If you're a nonprofit, the forgiveness taxability, I don't know, would matter. If you're just a really easy application, a sole proprietor or something, the bank could walk you through, you know, you'd still have the tax issue, but, you know, there may be certain circumstances where applying now may make sense. But Steve, I'll go out on the limb and just kind of say the default position is probably not to apply at least until next spring or so. At this point, absent anything that you know, any circumstances that would make it attractive to apply early.
Right, I agree. I think at this point, what we're saying is let's be patient. Let's wait and see if we get some more answers to a few of these issues that still haven't been answered. Unless, you know, you're in those circumstances that we went over earlier, selling a business, bankers not happy with your debt covenants or something like that, that make it where you would want to get that application in earlier rather than later. Again, we have, you know, you have 10 weeks after your, 10 months after your covered period ends to get that application in. So there's no strict deadline for each and every business, you know, other than whenever your covered period ended, you have 10 months from that date. So I would say we're encouraging, you know, patience and just making sure that you document everything that you can right now. Get your documentation in order so that you don't have to, you know, go hunting and trying to find things to add to your application when it's time to file. A couple other things just to, you know, point out, and Brent, you alluded to this on the earlier slide. There are some gray areas. There's definitely, it's not, everything is not black and white. So there's gray areas. You want to document how you arrived at your conclusions for those gray areas. You know, even after all these FAQs and IFRs have been issued, people are going to have certain situations that don't fit, you know, the standard mold, and you're going to want to, you know, exercise your best judgment again, and use what you can to document your conclusions. Not all answers are going to be easy to find. So just making good judgment is one of the key factors, and it's going to make a difference whether your application goes through. Your documentation is going to be important, and having that get through, you know, the lender and the SBA. if you have to file, if we don't get, you know, an exemption for a certain dollar limit, like we anticipate will eventually come, but you know, we don't know when.
Yeah. And one point I think that's on people's minds here potentially, just like getting in, to get out of this, the documentation that's required is going to be determined mostly by the lender. They have to package it up and send to the SBA certain things, but they may require more things. They may require different formats, stuff like that. So for those that are here wanting to know what documents do I have to get together, once again, unfortunately, it's really going to depend on your lender. They would have to speak to that. And again, I had wished a couple of them, you know, or one of them would have taken up the opportunity to just take 5 minutes and address some things here. So the point of this last slide, and then we'll start running to wrap it up, but you can, in full disclosure, you can apply early. So if you're in the middle of your 24-week, you got your PPP loan later than earlier, and you're in the middle of your 24-week, you can apply. You just have to prorate salaries and things that are eligible for forgiveness. So again, not to go into this too deeply, but if you compare this slide to the previous slide, you'll see things like Jan and Greg, I believe, are basically half because we're 12 into the 24-week. They're basically half of what was the previous slide. So again, you can apply early. You would want to do that very, you'd want to do that with consultation with your advisor. Specifically with them. So Steve, I guess we didn't really talk, but if you want to just go through here real quick, and then we'll move towards wrapping up.
All right, yeah, so this slide does, I mean, we spent pretty much this whole hour and a half talking about PPP loans, but there was and there is other relief available should you need it. This kind of, you know, lays out, there's an EIDL loan. I know some people have applied for that and also have gotten loan money for that loan. Employee retention credit, I believe we previously talked about this, but if you've gotten a PPP loan, you know, you can't use this relief. Employer payroll tax deferment. So this is on the Social Security tax on the employer portion. Can be used. You know, we are getting to the end of the year, so there's not as much, you know, relief, you know, from that at this point, but it's still, you know, potential to use that. Main Street lending, that this is open, and it's available for some larger companies up to 15,000 employees or 5 billion in revenue. So there, you know, some larger companies are eligible for this. And then there's also local additional relief. There's many state, local. I know Montgomery County has had relief programs. So those are out there also. You know, we mentioned the PPP2. Hopefully, you know, at some point that something comes through, but those loans will be probably more limited as to the, you know, nature of who's eligible and you'll have to show that you have had some kind of reduction in revenue from, from the talks that have been going on around those new loans. But so that's that piece.
All right, Steve, do you have any questions then to wrap up?
I do not have any other questions.
Okay. I only had a couple questions, I think, in terms of employee resignations, which I think we were pretty explicit with in terms of that's not going to count against you. They were asked before we went over that. And then I had a question from Karen that says, do we select our covered period 8 versus 24 when we apply for forgiveness? And that is correct. That's when you would make that choice with the application. So unless...
although Brent, I think, correct me if I'm wrong, but I think if you got a later loan after that 24-week period was available, I think you're automatically in that 24-week.
You're correct. So that's a good catch, Steve. And that date was June 5th. That was loans after June 5th have the 24-week. If you were before, you can make that choice. So, so in conclusion here, I'll just say in wrapping up, I think when we did the third one, we just kind of did a very informal poll that some of you would be interested in other Zoom meetings on other topics, depending on what the topic was, of course. So we got a good enough response, and I think we have a good enough participation through here. We're going to try and put something, I think, on in early January of 2021 about the Secure Act, and that was setting every community up for Retirement Enhancement Act. This was passed in December of 19, and it was a huge change for retirement accounts. And as you can guess, with the timing of the pandemic that started in February and such, this really somewhat got missed. So I think we're going to try and circle around that and, have our wealth management people in to make a presentation. In terms of Steve and I, this may actually be it for us. I was talking with Steve yesterday. Most of you are probably going to be or should be talking with your advisors for year-end planning and then going into tax season, certainly through next April. You'll be dealing with them one-on-one for your specific situation. And in terms of legislation, at this point, I think we have to get past the election and the ramifications of that. So there actually may not be anything coming out until early next year. So, this actually may be it for Steve and I. We said we wanted to do these when they make sense. So keeping that, this actually may be our swan song. I thought we did pretty good over the year, Steve, to go. We had 94, 95 participants or registrations today. I think we topped out at 68 or something, what I saw. I was at a Duck Donuts client yesterday, Steve, and she live streams, and she says she gets over 100 people live streaming at Duck Donuts. So apparently you and I are only about 60% interesting as a dozen donuts. So we're going to have to stay humble and keep our day jobs, but again, still try and do this when it makes sense. So yeah. If there's any other questions, really, please feel free to reach out with us. You have our contact information, be happy to help. And for those of you that have been through this, I had asked to leave us a review online. A couple of you have done that, and I really appreciate that. But I'd like to ask those that haven't, if you could do it again. I just really appreciate that for all the time that Steve and I have put in. So thank you for the directors and the firm for letting Steve and us do this. And thanks, Steve, for your participation over the 4 sessions. And good luck to everybody out there. And again, if you need anything, feel free to reach out to us. So Thank you, everybody.
Yes, thank you. Appreciate it, everybody.